All right, welcome to The Explainer. Today we're going to try and solve a mystery, one that probably feels a little too familiar if you have a bank account. We're talking about why your bank sometimes feels like it's playing a completely different game than everyone else.
You know that feeling, right? When you hear the big economic news says one thing, but you look at your bank statement and it seems to be telling a totally different story. It all boils down to one major frustrating question.
And this, right here, is the million-dollar question. When the central bank raises rates, your mortgage or car loan payment seems to jump almost overnight. But when those same rates get cut, it feels like you're waiting forever. So what is actually going on? To figure it out, we need to pop the hood on the financial machinery that connects it all.
So, to get to the bottom of this, we first have to understand the theory, right? How it's supposed to work. And the best way to think about it is like a big machine, a machine designed to pass interest rate changes from the very top of the economy all the way down to you.
Yeah, there's a fancy name for this whole process. It's called interest rate pass-through, or if you want to sound really smart, IRPT. But all it really means is how do the big policy decisions made by a central bank actually filter down and affect the interest you pay on loans and the interest you earn on savings? So in a perfect world, this whole thing is supposed to be super smooth, a simple three-step dance. First, the central bank makes a move, changing its main policy rate. Then, that change ripples through the entire financial system. And finally, your bank adjusts your rates accordingly. Simple, right? But how often is the real world actually that simple? Okay, so one way we can tell if this machine is working properly is to ask, is the pass-through complete? In other words, if the central bank cuts rates by 1%, do you see a 1% cut on your loan? If you do, that's a great sign of a healthy, competitive system. But if you only get a fraction of that, well, that's what we call incomplete, and it's a big, flashing warning sign that something might be off. But it's not just about how much of the change gets to you. It's also about how fast. Ideally, the adjustment should be symmetric. It goes up and down at the exact same speed. But what most of us feel in our guts is what they call asymmetric adjustment. Rates shoot up like a rocket, but drift down like a feather. And that feeling, that's really the core of what we're investigating.
So, is this all in our heads? Are we just imagining it? Or is this actually happening? To find out, we're going to dig into a really interesting study from 2012 that put the entire South African banking system under a microscope to see how this pass-through machine really works in the real world.
So these two researchers, Gideon Fadiaran and Abel Eziohaha, decided to settle this once and for all. They grabbed 20 years worth of data, a huge amount, from 1990 all the way to 2010. They looked at everything, deposit rates, lending rates, and what the central bank was doing, all to find a real, concrete answer. All right, so what's the verdict? After crunching 2 decades of numbers, what did they find? Well, the results are pretty fascinating. And honestly, if you have a bank account, probably not all that surprising. It turns out that feeling we all have, it's real. The data confirmed it. When the central bank raised rates, the interest you earn on your savings, yeah, that was super slow to go up. But on the flip side, when the central bank cut rates, the interest you pay on your loans, that was just as slow to come down. The machine is sticky, and funny enough, it's sticky in a way that always seems to benefit the bank. And the researchers had a specific term for this. For your savings, they called it upward rigidity, meaning it's stuck on the way up. And for your loans, it's downward rigidity, stuck on the way down. It's basically the academic way of saying your loan rate is like molasses when it's supposed to fall, and your savings rate is just as slow when it's supposed to rise. Okay, so that just raises a huge question. Why? Why is the system wired this way? Are banks doing this on purpose, or is there another explanation? The paper actually dives into 2 big theories. So you've got 2 competing stories here. Theory number 1 is the adverse customer reaction theory. The idea here is that banks are actually trying to be careful. They're slow to change rates because they don't want to upset you and risk losing you as a customer. But then there's theory number 2, collusive pricing. This one suggests that when you only have a few giant banks in the market, they don't really have to compete hard. They can just kind of implicitly agree to keep lending rates high and savings rates low to pad their own profits. So which one is it? After looking at all the data, the study's conclusion was crystal clear. The patterns they saw just didn't line up with the idea that banks were worried about upsetting customers. Nope. The evidence pointed squarely at collusive pricing arrangements. Okay, so you might be thinking, that's one study in South Africa. What does that have to do with me? Well, it matters because the forces they talk about, things like market competition and profits, those are universal. Let's look at the two smoking guns that led the researchers to their conclusion.
First up, competition. Or more accurately, the lack of it. Just look at this table. For years and years, the top 3 banks controlled a massive chunk of the market. We're talking over 80, sometimes over 90%. When you have so few players calling the shots, the pressure to offer you a better deal just disappears. It makes it way easier for them to keep rates right where they want them.
And what happens when you have very little competition? Well, take a look at this. The second piece of evidence was bank profits, specifically something called the net interest margin. This is basically the profit they make from lending. And guess what? With so little competition, those profit margins were not only high, they were often growing. This wasn't just a theory anymore. You could see it right there in the bottom line.
Okay, let's wrap this all up. What are the big takeaways here? Number 1, the changes from the top, they don't always make it down to you. The pass-through is often broken. 2, your loan rates fall way slower than they rise. 3, your savings rates rise way slower than they fall. 4, a huge reason for this might be a simple lack of competition in the banking sector. And 5, the bottom line. It means less money in your pocket and more profit for the banks.
And that really leaves us with one last big question to think about. This study gave us a really clear window into what was happening in one specific market. It showed exactly how the structure of that market can directly impact the rates you pay and earn. So the question I want to leave you with is, what's happening in your market? Thanks for joining us on The Explainer.